Hey everyone, me Kevin here. Welcome back to another closing live stream. Okay, let's talk about stocks and will they crash again? Are they definitely going to crash again? Are they maybe going to crash again? And really what's going on in this market? Because I've been studying this market for, well, every single day this year. And I noticed some similar patterns with what this market does. And I think it's kind of funny. Uh, but what I want to do is I want to show you kind of what I'm seeing. So take a look at this, okay? What I'm going to do is I'm going to take us back here on N phase. I'm going to go back to May and take a look at this, okay? So this market was booming from 2020 through to about February 19th. Remember when we got pray on the Bloomberg terminal and it literally told us to pray, and stocks plummeted for the next 3 months thereafter. And in February, what did our market do? In February, people bought the dip. We bought the dip. But unfortunately, the dip kept dipping in February. Remember that? People were like, oh, this is like a 17-layer dip. So the market continues to dip. The market falls into March. Market then falls into May. And we get this long extended period of time where we're like, we're out of money. Oh my gosh. And what's kind of crazy is that we've been so accustomed to buying the dip that the market, having so much cash, is now so used to buying the dip that I personally believe anytime we get the beginning of a red period of time, the red period lasts longer and longer. Lasts shorter and shorter. You got to phrase that correctly. The red lasts shorter and shorter. Now, we don't know if this will continue, but here's what I mean. When we had this red period here at the beginning of the year, we really spent these first 2 months from after when it started, around February 19th to around mid-April, having this sort of pain. And we had these really short spurts until we really got this fall, this almost like 2.5-week fall here in May. And this was really the pain of 2020. And then ever since then, we've had these shorter periods of dips. We've had these maybe 4 or 5 day periods of dips, which we kind of saw the third week of July and the third week of August. And we've seen here, but we seem to buy them up regularly. Now, this is end phase. And end phase just hit a low of about 149 yesterday, and it's kind of starting to rotate up again. But I'm noticing this in many different stocks where when we get these dips, they last for a few days, they get bought up. They last for a few days, bought up, few days, bought up, few days, bought up. And we've really become this sort of buy the dipper kind of mentality of stock market. And, while a lot of this, I mean, look at some of these gains here, right? You've got Lucid up 11%, Matterport 11%, Emrin 10%. I mean, these are some incredible numbers here. Dutch Bros went from being negative this morning to being up 7.17%. So we're seeing a lot of this capacity to take money and after a dip, throw it into the market. I see that consistently over and over and over again to where, yeah, we'll get these dips. For example, right now I'm looking at Wynn Resorts. Wynn Resorts kind of been on this little downturn here, mostly starting here because of Delta. Delta pushed this down. Now we've got the sort of Chinese drama and Chinese debacle. And this is one place where I've expressed a lot of caution for buying the dip because the Chinese drama has just gotten worse and worse and worse. You look at BABA, this is probably your worst possible buy the dip here, right? It's something like Alibaba, where it just continues to go down and down and down. But otherwise, buying the dip and just keep buying the dip has generally been rewarded. Look at DocuSign just as an example. If you just bought red every single time here, you generally got rewarded. Let's think of another one here. So Enphase, a good example. Generally, although we're still kind of in a dip right now. Let's go to Trade Desk. Let's do TDD. So Trade Desk here. We've had these dips. You've got Kathy Woods buying the dip over here as well. Kathy Wood buying the dip on Trade Desk. But Trade Desk, let me try to rephrase this. Where I'm going with my sort of thought process here is I'm finding that because of our reverse repos at the Federal Reserve and institutions having so much money, I'm finding a lack of true pain coming to the market. That's where I'm trying to go with this. A lack of true pain that's actually keeping stocks into lower, more painful periods that could lead or rival what we saw during the pain that we had in May. We had our volatility index spike higher than what we had in May, but our prices didn't get to May pricing again. That's what was so weird, is we had more fear technically per the charts than we had in May, but pricing didn't get anywhere near May in many stocks, with the exception of some recovery stocks that got pushed down because of either China, like Win, or just Delta fears. If we look and compare a lot of our stocks to May, we're a lot higher despite the recent kind of falls that we've had. So look at Trade Desk, a lot higher than where we were in May. Look at Enphase, a lot higher than where we were in May. Look at Tesla, much higher than where we were in May. And this is, or even AMD. Let's go to AMD. Look at that. AMD was at 72 in May. This was the last time that I really plowed money heavily into the market. And since then, I've really been along the way, along this sort of slow ride up. I've been closing out a lot of options. I've been closing out call options that I've had, and I've been taking profits on sold options, like sold puts and sold calls, and building up cash. Now I've built up a lot of cash because I've been selling the contracts, the options that I've had that have been profitable. And I'm kind of sitting there looking at the funding going, wait a minute, like, when are we going to get back to a May style dip? And the market has been really good about staying away from May style pricing. I was really hopeful that we were going to get back to May pricing when we had our volatility index as high as what it was in May, and even higher at one point yesterday. I mean, look at the VIX here. Look at the VIX. So go to the day chart on the VIX. And there we go. So let's zoom out here. Okay, here we go. So May, it's a little easier to see when you just pull it down like this. There we go. So May was right here. This is May. And yesterday, intraday, we broke above this line. It doesn't show that ending on the day chart. So if I go to the hour, see how it breaks this blue line here, that 2774 right here? That doesn't reflect on the day chart, but we broke May's high, which was 2759. And yesterday we hit, what was it? 2774. See, we beat May in terms of fear, but we got nowhere near that kind of pricing. And that's why I believe we've got this really bizarre market that's really spurned by the fact that we've got too much cash. The markets have too much cash. That's why the American markets can't fall. It's a really good thing. Like, don't get me wrong. Like, grand scheme of things, it's wonderful, right? Grand scheme of things, it's great. It means the market is so resilient to price shocks. But in terms of wanting to buy the dip, it's also very frustrating because it's like, wait a minute, the dips aren't that good. Yesterday's dips weren't that good. The companies that sold off 10% yesterday and got 10% back today, like Lucid and Matterport, they're not good deals, in my opinion, at these prices. And so that's where I look at, okay, well, what's left at a dip, right? Well, one of the ones that I've been dip buying is Enphase. Still, we don't get the May pricing, but it's still not at euphoric pricing. It's certainly not past February pricing. It's not even close to February peaks. It's not even close to recent peaks in pricing, where at Enphase, we usually seem to peak out right around 200. We get those resistances in 200. Sometimes we run past that a little bit. You know, same thing with Tesla. We haven't seen that kind of February style peak yet, though we've been on a wonderful uptrend for Tesla. Yesterday didn't really stop Tesla. Tesla sold off like 4%. It's back 1.2% today. Redfin's one of these, because I keep getting asked about Redfin. And one thing that I find with Redfin is that the only thing I could say in terms of why you've got Redfin, Zillow, and Open Door that haven't been performing so well since February, and they've been on this rough downtrend, they've been sort of channeled to the downside. One of the things I realized here is you really have a sector that got a lot of excitement. Oh, here, the easiest way to explain this is like this. Watch this. So let me go to Investor Relations, Redfin. And I saw this when it was happening, and I talked about it while it was happening, and I thought it was really annoying. but I think the market finally realized the revenues these folks were using are not exactly what you think. So let me give you a quarterly here, and you'll see what I mean. It's worth seeing this. So go to, not a proxy, give me a quarterly. There we go. Okay, here we go. Quarterly from August. Watch this, okay? Revenues. Come on. Okay, here we go. Okay. Product revenue and service revenue. So obviously great growth since 2020. But one thing that people look at a lot is this product revenue. But something to know about the product revenue at Zillow, Redfin, and Opendoor is mostly or mostly has to do with their house flipping business. And so over here, you're like, oh my gosh, look, they went from 72 million to 172 million. That seems like a massive kind of growth, right? But their expenses went from 73 million to 167 on those same properties. So it's like, this really, if we got rid of this line and this line right here and just put the net in here, it'd be like an extra $5 million of revenue. It's actually not that much revenue growth. Now, the service line, this is wonderful, really excellent service growth, and that's where the company's making money. But on the house flipping, which is what Zillow's doing like crazy, Opendoor's doing exclusively, and Redfin's doing like crazy. On house flipping, you've got lots of revenues, not a lot of profit. I mean, you're talking about like maybe 1 to 3% profit is what you're trying to pull out of these. And I think Wall Street for a period of time got enamored with these stocks as like, oh my gosh, these companies, their revenue growth is insane. And so you got these insane peaks at Zillow and at Redfin and at Opendoor because Wall Street was like, look at all these new revenues that are coming in. And it wasn't until there was almost this realization that, wait a minute, those revenues aren't profitable revenues. Those revenues like kind of worthless revenues that the market kind of a bit, because when you look at the forward price to earnings on Redfin and Zillow and Opendoor, they're not like exceptional deals at these prices. And so that's why I haven't been super excited about adding to sort of the real estate companies either. Now you look at something like Etsy. Here's another great company. Like my favorites, the ones of my favorites that are back to May prices, or none of them are. Like if I could get them back to May prices, golly, I'd love to buy just millions of them. But anyway, Etsy's another one where it's like great company. I've loaded up on Etsy so much, but it's just not at a particularly juicy price right now. Let's see what's another one. Let's do, so we did Enphase. We talked about Etsy. Enphase though, out of them is still at a relative low. So that's where I've bought that one a few times over the last 24 hours here. Let's see here. Canoe, Hut 8. Hut 8's rotating with crypto, and I'm doing a larger trade on crypto, although I did just buy a little bit of crypto in the dip that we've had over here. Let's see. Recoveries are something else that interests me because recoveries didn't have, the thing is, while they turned slightly red, they didn't have that deep bleed like a lot of the tech companies did. Let me see how Nvidia did during May. Yeah, see, look where Nvidia was in May and where it is now, right? It's insane. I mean, you're almost double, not quite, almost double what you had in May. Yeah, less than double, but anyway, still pretty huge difference here. Always a dip and never a rip. Let's see here. I know. Yeah, that's I see the comments here about wanting to find pain in the market, and the thing is, pain is being so quickly absorbed by how much cash there is. It's really become it's a frustrating thing for buy the dippers. It's a great thing for the market in general. Let's see here. Yeah, Airbnb has been, see, Airbnb got to its May dip in July and has recovered really nicely since then. Nice recovery. Still not where it was, but look at this wonderful growth. I mean, this is just like stable growth here. That's the same kind of growth that you saw at Tesla. You know, this was a little erratic and quick to come about. Here's SoFi. Been a little bit of a sideways trader as well. SoFi, if you know, is one that's kind of sitting closer to those May levels. I like the relative to May, and the reason I always go back to relative to May for fintech or tech is because there was serious pain then. So I do like that. Again, we talked about Zillow, Open Door, Redfin. The problem with these right now, Upwork, not too far off of its May pricing, 37, 38, sitting about 49 now, but not too much of an extension above that. Let's see, Robinhood. Robinhood has been, as since its IPO, obviously lost a lot of excitement. It lost that sort of euphoria at the bump. It is over IPO price, though. I think you could probably see a consistent growth on Robinhood, kind of like you saw at Airbnb. That wouldn't surprise me, that you kind of get the hate out of Robinhood and you see a nice slow growth at Robinhood. Trade Desk, obviously up substantially from that May dip. This is the first time I bought Trade Desk, was during that May dip. But yeah, now it's like tough, right? And I think that's how a lot of us feel. It's just like, do we really have big opportunities? The Chargers have been kind of interesting. The Chargers have had May dips. They're not too far off of their May dips either. You look at Blink, the May dip was around 27. We're at like 29 right now on Blink. You look at ChargePoint. ChargePoint broke $20 today, folks. I mean, look at this line, this support line that it's been sitting at, and it's just been stuck at that support line for quite a while. Solar Edge, and kind of the solar companies, SunPower, they're off their May dips, most of them. Let's see here. Actually, look at this. SunPower found one close to its May dip again, so that might be another one to look at. SunPower, Solar Edge was off the May dip. Yeah, Solar Edge is nicely off. So SunPower, write that down. SunPower. Also, DraftKings is down substantially today. Look at this. DraftKings down here to 52.78 relative to May, where it was at 39, and the end of July, where it went to about 41, 42. So an interesting potential opportunity here. Win keeps dipping, and again, concerns here obviously because of the Chinese issues. And you don't want to look for May dips and recovery stocks. So keep that in mind as well. It's so, you have to be so compartmentalized with fintech and tech. They had the big May dips, and I like comparing those to see what's been left behind, so to speak there. Roblox, see, here was the May dip for Roblox. Roblox went back to about IPO pricing around that 65. I like the idea of keeping an eye on Roblox, especially if we could pull this one back down. I don't know if we're going to revisit some of the May pricing, though. It'd kind of be like looking at Enphase and going, oh, yeah, eventually it's going to go back to May pricing. Not necessarily. We'll see. But Enphase is one I'm happy to just dollar cost average in on. And I think that's where there's a potential strategy in just averaging into this market, still maintaining good cash. Like, I still believe in RCC, don't get me wrong, real estate, cash, crypto, and I'm playing a crypto dip trade right now, but buying real estate, finally closing. It's not closing today, it should be closing tomorrow, my real estate deal, writing an offer, another one. But real estate, cash, crypto. But I don't want to let my cash position get too ridiculously high. Still getting out of those call positions as I can. And we got FedEx, looks like, reporting after the bell, so we'll take a look at that. But in terms of fintech and tech, where can I dollar cost average in to really take advantage of just placing money and then still having a balance of cash, but not too much? See, like, here's a nice dip on Google, but then again, I mean, it has had this insane, incredible run. I mean, how much are we really down here? It ran up to 29.36. Now it's at 2,800. Okay, so 2,800 divided by 29.36. We're down. Hey, we're down about 4.5%. I got rid of my call options on it, which was great. We took some nice profits on those last week. And, if you were to cash park some cash, Google's been pretty insulated. So write that down as well. Google. All right. Disney 150. Disney's a great company. I did see that Disney dipped a bit today. I do want to figure out exactly what happened, because this to me looks like a news event here on Disney. Yeah, Disney looks, or Google looks exactly like the SPY. Yeah, that's because it's one of the biggest weights in the SPY too. So we'll keep that in mind. Disney down on subscriber growth. Okay, so that's kind of like a Netflix pain then, right? Okay. So let me go ahead and pull into what we got here. Oh, yeah, here we go. Walt Disney CEO said movie and TV production delays would temper the growth in new streaming customers that some analysts are expecting. Well, there you go. They basically issued a warning saying, hey, just a heads up, we're not going to be doing as well as you think. So anyway, I just want to be clear. I'm still very, very, like, in my opinion, I'm in the highest cash position that I've really been in a very long period of time. And as usual, anytime I send out alerts, I send them out, or anytime I buy or sell something, I send out alerts in the Stocks and Psychology Money Group, which is always like a weird feeling because it's kind of like, I always say want the best for the alerts, but it's just like you feel naked because it's just like you just put everything out there. But it's actually a good thing because what I always recommend is that you write down your strategy and you have some form of a written strategy for when you're investing. And that for me is just like the perfect way to force myself to write everything down because I write my thoughts. I put my thoughts in like, hey, do we think, how much do we want to prepare for a dip? Why am I closing call options? Well, okay. Why am I buying? Am I DCAing in? What am I doing? So yeah, very, very interesting to me. This market. It's not something where I feel compelled to go all in on. I also, it's this weird feeling. I also don't feel like I'm necessarily missing out by having a larger cash position in a broader sort of diversified group of stocks because some things have somewhat traded sideways. And that's where I've been selling puts. Selling puts are great when things move up a little bit or trade sideways. It's wonderful. So it's just a crazy market. Let's talk a little bit more about it here after the bell. All right, here we go.
Pretty much unchanged. The Dow down 30 points. The Nasdaq stays positive, up a third of 1%. And Paffrath also rebounds by about a quarter of 1%.
There you go. Okay, the S&P literally just went negative before our eyes here. Dow down 0.15%, S&P down 0.1% now, and Nasdaq's up 0.21, and the Russell's up 0.19. So what'll be really interesting is if tomorrow we end up getting some red again, because here's something to pay attention to as well. I would write this one down. And I'm going to pull up FedEx really quick. But I would write this one down. In fact, I'm going to write it down, okay? Pain before 11 a.m. Pacific. I'm going to write that down. So, and I might go into tomorrow with that sort of DCA strategy on things that I believe haven't run away excessively. Like, I hate to say it, but I feel like Matterport a little bit has run away a little excessively to the point where I've taken some profits on Matterport. And great profits on Matterport, actually. We love Matterport. But and it's a company I want to own and buy more of. But it's not a company that I'm married to when I think there's like a runaway. So and not all companies would I be willing to trade out of a company because I feel like it's run away. That would be more companies that I feel like have a market deemed anchor. And a lot of SPACs do. A lot of SPACs have sort of a market set anchor. And sometimes they stretch away for 2, 3 weeks, 4 weeks, whatever, and they come back to their SPAC reality, so to speak. Anyway, I've got FedEx earnings ready, and I do want to talk about my strategy for tomorrow right before I pull up earnings here. We've got a few minutes before earnings. Earnings, whispers, calendar. The market, okay, so we have Adobe and FedEx today. So the market is really difficult to articulate well, but I believe the best way to describe it is if you're looking to get into tech and fintech, probably the best thing to do is have some cash on the sidelines, maybe that's 10% cash of your portfolio on the sidelines. Have long positions. Maybe use some of your collateral as to sell puts to potentially get into positions lower. But when you want to be and build out longer positions in companies you want to buy and hold, and you have the potential or you suspect they have the potential of running, buy the shares. There's nothing wrong with just buying the shares because you've got massive theta decay on call options. On sell puts, they could run away from you, and on sold calls, they could run away from you. That's not to say don't take advantage of those, but DCAing in on some shares while still maintaining cash, especially as we get, as some stocks have not advanced as far away from May lows as others. Again, like Etsy versus Enphase is the perfect example for me. I think then those are just opportunities where you say, hey, take advantage of the little dips, average in a little bit. Maybe you're lowering your cost basis. Maybe you're even increasing your cost basis a little bit. And I personally am. I'm increasing my cost basis a lot on Enphase. I started buying Enphase early. And every time I buy Enphase, my cost basis goes up. I don't really care what my cost basis says. I care more about making sure that as my portfolio grows, I'm allocating to all the different companies that I really believe in and sort of growing that pie for all of them. So yeah, I hear crypto is crashing. Let's see here. Well, I don't know how much it's really crashing. Let me see. BTC. No, not really. I wouldn't say it's crashing. So I just bought the dip on crypto a little bit ago. It was lower than where it is now. And now it's recovered a little bit since I bought, so nothing too surprising there. But yeah, I just bought the crypto dip. And we've got earnings in about, I believe, 1 minute on Adobe and FedEx. So we'll knock those out quickly. So let's see here. Okay, Adobe. Okay, yeah, Adobe FedEx up. Good. So, yeah, ADA, I don't know if we're going to see ADA $1 again, honestly. Oh, but what you will see is up to $70 in free stocks with Public by going to mettkevin.com/public. mettkevin.com/public, you get up to $70 in free stocks. They do not buy or sell your information, and they do not use payment for order flow. FedEx just came out. EPS comes in at $4.09, adjusted EPS $4.37. This is a miss, folks. Uh-oh. This is a miss on FedEx. That is they had an estimate of $4.92 on revenue, came in at $4.37. I'm sorry, on EPS. Operating margin came in at 6.8%. The estimate was for 8.52%. That's a miss on the bottom line. That's a miss on margin. They did beat on revenue, $22 billion versus $21.88. FedEx reduces its earnings outlook to reflect Q1 results. Okay, this must be their Q1 here. Yep, reduce their outlook as well. So guidance down, bottom line down, revenue beat, but margin down. This is overall this is 3 out of 4 pieces are negative here on FedEx. Shipping rates to increase for FedEx Express ground freight services. Let's see here. Earnings infographic. That sounds cool. Yeah, that's painful there on FedEx though. Okay, Adobe is out as well. Adobe just came out. Adobe digital revenue is almost $1 billion. Wow, $985 million. That's for digital experience revenue. Digital media revenue, no idea what the difference is. $2.87 billion. Experience revenue up 26%. Media revenue up 23%. Let's see, EPS 311. Looks like we got a beat on estimates for Adobe. We came in at 311 on EPS versus 301 expected. Revenue came in at about 4.07 versus 4.04 expected. So it looks like a beat on rev, beat on EPS. Yeah. Okay. So FedEx was rough. Yeah. Oh, yeah, and I wanted to talk about the 11 a.m. thing tomorrow. I got to do that. So FedEx had a little bit of a rough miss here. I think Adobe was more along expectations. FedEx falling in after hours, obviously. You would expect that. It doesn't seem like it's that horrible of a drop, though. What, a couple percent here on FedEx? I think so. So FedEx going down. Oops, FedEx. Let's just throw you in the watch list there. Why not? Okay. So FedEx is down about 2.5% here in after hours. And Adobe, which is a great company. Oh, wow. Adobe actually down too. See, that's the funny thing about playing earnings. Just notice playing tech earnings is scary. Playing recovery earnings has actually been good. Like, remember we did the Dave & Buster's play? That was great. Let's see here. So that was, yeah, look at that. Adobe's actually falling nicely here. Adobe's a company that I would consider opening a position in. Oh, so let's see what happens here. Mhm. Okay. Yeah, down 4% right now. Let's go to the day chart. And then let me tell you about my thoughts for 11 a.m. Hold on one second here. I just have to send this. Okay, there we go. So I'll tell you about my thoughts about 11 a.m. One second. Let's zoom out. Oh, wow. Look at the run, though, that Adobe has had. It's really incredible. Adobe's just done phenomenally. My goodness, Adobe's done very well. Very, very nice here. So, I mean, 4%, 3.7%, maybe because it wasn't as much growth as it was expecting. But I mean, that's a drop in the bucket relative to just how well Adobe has done. Really incredible. Let's just compare for a moment. Let's see how Amazon's been doing. See, Amazon's been trading a whole lot more sideways. They really had a trouble breaking out of this channel here. And Apple has kind of broken out. Nah, see, but they're heading back to that channel. Fascinating. A lot of channeled companies. The exception of things like Google. Google, Adobe have just been straight up. Square's kind of been stuck around the same price for a while. Yeah. Huh. Amazon is the Illuminati. Changed my mind. Oh my gosh. Anyway, okay, so let's talk about the 11 o'clock thing. So you've got tomorrow the Chinese economy coming back, or not the economy coming back. The government comes back. Government comes back, and there's some talk about maybe some regulatory announcements that might come out with Evergrande. Tomorrow, you've also got the Federal Reserve. They'll talk about whether or not they'll have ended up tapering tomorrow or not. We'll get a new summary of economic projections. So, and we should know a little bit more about where this debt ceiling negotiation goes. I think everybody expects the debt ceiling negotiation to be fine. So I'd say there's probably a little bit more catalyst for negativity tomorrow, especially since tomorrow will also be the day before the Evergrande potential crisis, because you've got the next debt payments due for Evergrande on Thursday. So I think that there's a chance that calls on Evergrande. Yeah, I don't know about that. I think there's a chance you could see some pain in the market before 11 o'clock tomorrow, because 11 o'clock Pacific time, that would before that time frame. I think the market might be tentative because of Jerome Powell, because of what happens with Evergrande, which I think we'll hear a little bit more about tonight. But what we hear about tonight when the market opens in China this evening will be more, I think, anticipation for Thursday when there's a chance of missing debt payments. So I do think there's reason to expect the market to be red tomorrow, but I don't expect us to have massive pain. The market's just been so resilient. And that's where it almost just seems like DCAing on some of your favorites that haven't run so much since May is not a horrible strategy. It's again, like you saw what happened with Tesla here. I mean, just look at some of these great companies here. Okay, so great companies. Tesla, you've got this nice growth trend. You could DCA in really anywhere along here, and you'd be okay, with the exception of if you bought in like February and then you'd never bought again, right? You bought Google anywhere in the past year, you're probably fine. Amazon, little tougher because we've had some crazy fluctuations. But hey, as long as you didn't buy here within like in July while it was running, should be okay as well. Same thing, Apple looks pretty similarly. There are some companies that have had exceptional kind of pain though, where they have not recovered from some of their May, and that would be a company like Pinterest. Pinterest has just been getting wrecked. I'm going to pull up the financials really quick for Pinterest. Okay, so Adobe. Adobe's still growing like crazy too. Okay, so Pins. Pins has been one of those holdouts. All right, so Pinterest. Here we go. So Pinterest, one thing that's fun to note about Pinterest is that they're expected to have a $1 EPS by the end of the year, which means it's profitable. You know, unlike some of the newer insurance companies. Oh, Stitch Fix just shot up like 15% on a revenue beat. That's cool. Unlike some of the other companies that aren't profitable, Pinterest is profitable. Now it's trading for about a 50 times earnings multiple for 2021. However, this is a company that's expecting to experience somewhere around 30% growth for the next 2 years, and then probably closer to 20% growth thereafter. And if let's do a little trend analysis here on pins. All right, let's see here. Just a little trending. Pinterest. I don't know why people is that's been one of the downsides of pins. And I know it's very app based, but Pinterest has become, it seems like, less desirable for some reason over the last sort of 5 years. And so this is a risk factor for pins. You know, generally what you prefer is to see growth. Like, let's try Etsy just for comparison. Yeah, okay, exactly. Pinterest. There you go. Look at the last 5 years here on these two. So look at Etsy pass Pinterest by a lot and really still grow above. Now, Etsy has also been slowing down a little bit here in 2021, which kind of makes sense that you're out of the sort of the pandemic era. Everybody's at home using Etsy kind of on a regular basis, right? Kind of makes sense. I wonder if you would see that with Amazon as well. Let's throw Amazon in here. This might skew the chart substantially, though. Yeah, it will. Okay, let me just look at Amazon. Let's see here. Okay, just Amazon. So Amazon has seen the same kind of decline here as Etsy in 2021, but it's also, this level is still, that level is, slightly below the pandemic, but above pre-pandemic. See, the relative strength here is about what you get to about high 60s. Yeah, here you're high 60s, low 70s. So that's good. It's about the same on Etsy, which is great. You know, we'll take that. Yeah, you're substantially higher than where you were in 2019. I mean, way higher. This is one of the reasons Etsy, in my opinion, has been running. It's an incredible company, and I own a lot of it. I'm very happy with it. But yeah, Pinterest, that's one of the downside risks of Pinterest. And so it's like, well, why is Pinterest kind of, doing this? Well, possibly because the market has sort of transitioned, or people have lost interest potentially in Pinterest. And that's dangerous, right? It's kind of like the potential that people have lost interest in shopping in retail stores. It's like, sure, you had this devastation on retail stores like Macy's and Nordstrom's or whatever. But still, you eventually, like, how much are we still going to Nordstrom's? Are we buying more online? I don't know. I don't really shop for clothes that much, so I'm not a clothing expert, which is one of the reasons I generally don't get involved in the clothing companies, any of them, like Lulu, Nike. I think it's good to be a strong customer of the companies that you're investing in. Let's see. Let's explore a little bit more here. So crypto. Oh, looks like crypto just dipped a little bit more. Yeah, that's on the 1 hour chart. Looks like, yeah, on the 5 minute, we're rotating down a little bit more again. So that dip is sort of rotating a bit more. I've got a larger trade that I've been doing on crypto where I sold a ton of my crypto a couple days ago, and it's down from there, which is great because I've kind of been DCA nibbling back, and so it's been just a little trick to lower my basis. It doesn't always work, obviously, but it's worked very well recently. Okay, so what else? I mean, we love Enphase, we love Etsy. I talk about them all the time. I do love Apple and Amazon, but I've got a good position in them to where I'm not convinced that I have to keep adding to them. Google is something I'd be interested in creating a bigger cash park position in, and honestly, that might be something to do where you almost just have like a cash park pie, and you throw it in, and then it's like, here, that's for cash park purposes, and then anytime I want to go buy the dip on something, maybe you pull a little bit from that pie. That's possible. What would be neat, what would be really neat, is you do a pie of stocks that have gone down. Okay, So stocks that are still relatively rubber banded to their to their lower levels. So for example, maybe that looks like Enphase, right? Well, obviously, I've mentioned that one a few times. You throw in, isn't AMD? AMD's rotated a bit down, right? Yeah, maybe you throw in like, it's kind of like an Enphase, AMD, and you call it like the pain pie or something like that. The new pain pie, where they're really great fundamental companies, but you kind of park your money in them as a little bit of sort of a cash park, but then also a buy the dip. See, look at that. Disney now is at its May pricing again. I'm gonna put Diz on that. Enphase, AMD, Diz. What's another one? The pain pie. Somebody help me make the pain pie. The C3AI I've been a little concerned about. I bought that one. The only reason I ever bought that company was on a trade, and it was really because it had such a strong support line. And then the stock just didn't care. Like, this was a very strong support line. I mean, we had on the hour chart, on the day chart, we were bouncing off this thing like crazy. But as you can see, it didn't give a crap. It did not give an F. CrowdStrike. CrowdStrike, Cloudflare. These are interesting. I'm going to put those on like stocks of interest. CrowdStrike, question mark. How's Cloudflare? Or like Cloudflare has just been ripping. What about like Fastly? You know, look at Fastly. It just like evaporated. And then there's the concern of like, well, is this pulling a Pinterest, right? I'm going to put a question mark on that. I think this really requires sitting down and doing a lot of research on. Yeah, ChargePoint, the chargers. Yeah, absolutely. The chargers have been something where they've really been part of the pain pie. I would agree with that. CHPT. How have the other chargers been? I did this little pie for chargers. Let me see. Tilray? Is that cannabis? I think it is. And yeah, that's cannabis. No. Sorry. After running a then this could just be my bias and it could be entirely wrong. But after running a campaign in California and realizing how stupid government is at legalizing marijuana, no thanks. I want to figure out what's going on with the chargers. I'm gonna put I put ChargePoint on the pain pie, but EVgo has been, look at it, it's below IPO over here. Like what happened to EVgo? And then we'll put in like Volta. Oh, Volta popped up a little bit, but I put EVgo, Volta. I'm going to do some research on those to figure out why is there so much pain over here in these guys. So coin is going to be more of a crypto play, right? I would dance that over with like Hut 8 and I'd lump them together. But yeah, I'd like to keep my crypto separate from my stocks. Just sort of mentally, it's easier to trade them separately. So I'm going to keep that one separate. What else belongs in the pain pie? I mean, I know Adobe's down like 3.75%, but is this really pain pie? I'm going to put, though, because maybe they don't all have to be in heavy pain. Maybe it could be recent pain. Like I'll put in Google and Adobe. I'll put little question marks on them because they've been a little bit red recently here. So we'll put Google and Adobe in on the side there as sort of more recent by the dips. NVIDIA has had a little bit of a recent pullback. Again, still crazy pricing, right? Put NVIDIA in there. NVIDIA. Yeah, and this is really turning into like a tech and energy. I suppose maybe it'd be worth having some kind of like, I don't know, do we care about like staples? Consumer staples? I mean, look at Target. Target's rotated down a little bit. I guess this is where you'd have to ask yourself, do you like Win? That's a pain one. That's got the Chinese exposure. I'd be willing to say that belongs on the pain pie. And just for balancing sakes, I mean, gosh, and I got to go soon to an interview here, but which will be on the channel, by the way. Actually, yeah. Hey, everybody watching right now, it'd be cool if you stuck around. We're going to do an interview with Smile Direct. So I will do a little Let me put that up really quick here. But I do want to talk about this. So let me type in, what was the company? Target, TGT, right? Let me just pull up their earnings really quick. Okay, financial analysis. Or you know what we might do is why don't we just do it as part of this and then I'll record it because you're all already here. It's so much easier to just do that way. Yeah, I'll just do that and I'll just record here. And we'll do this. Change link to this. Change link to this, please. I think it's going to be easier to include it as this, and then I can just post a separate video. So anyway, we'll do that. I don't think any of you really care if we do that, right? I don't think so. Oh, but am I going to be able to record it? I'll figure that out. Oh, yeah. Okay, here we go. Okay, so Target. See, the problem with Target is you're not expecting massive growth at Target. You're sitting at, let's see. Okay, here we go. Yeah, Target is expecting to have 8% growth next year. And then we're expecting to get to 2.5% growth, 2.9% growth, and 4.0% growth. So not as superb. Target parking cash. I could see as like a pain. Do we call it like a? Maybe we call it a pained cash park. New pain cash park. How's that? Pain cash pie. Cash pain pie. Cash pie. Something like that. I'm going to write it down. TGT. Slow growth. And I don't love the slow growth. I mean, Wynn's got more than this. What about Wayfair? That's Beyond Meat. Yeah, they've been wrecked here recently. Okay. See, the interesting thing about Wynn is they have good growth expected, but it's really because it's more of a reopening play of growth. But still, I mean, they're expecting massive growth this year, still expected to grow almost 50% next year, and 16% in 2023. It's incredible. So let's see what else we have. Beyond Meat. I'm going to say Autodesk. That's another interesting one, too. Hold on, let me write that one down. Autodesk. Yeah, that's a great like SaaS model, right? That's really good. By the way, before our interviewee comes, I just want to make a quick mention to always take advantage of that coupon code that does expire Friday. We are going to put in a nice inflation bump in the pricing this time, as we usually do when the coupon expires. But this time we're really going to look at inflation and go, got some inflation, got to price it in. So take a look at that link down below. See, Autodesk is growing pretty nicely. 15% 2022 projected, 18%, 14%, 12%. I mean, this is pretty incredible. How's their stock been performing? Let's see here. Autodesk. Yeah, look at that. That's a good one. Hey, shout out to whoever mentioned Autodesk. See, now that I like. I'm going to write that one down. I'm just going to put that one right in. ADSK. That's not bad. Autodesk. DraftKings, I think, potentially deserves to be in here as well. DKNG. Yeah, crypto falling again a little bit here on a downtrend. I'm going to watch this because I'm down to potentially grab a dip here. Somebody mentioned Honest Company. They're so new. They do have some incredible growth ahead of them, and they've gotten obliterated. What I might do is let's do a trend search and maybe a website search on this one. So let's see here. Okay, let's do an Honest Company trend search past 5 years. See, and that always concerns me. Look at this. Their recent interest has been because they've gone public. When did they go public? May 5th. Oh, what a rough time to go public. And, yep, May 5th. That's the peak right here. That's the peak of search trends. But since then, on a relative strength of search, you're down. You know, they were a lot hotter of a company back, at least in search trends, in 2016, 17, and 18. So I probably wouldn't, just like I'm not going to put pins in, I probably wouldn't put Honest in just because of this decline in trust. You know what would be interesting? Honest Company Investor Relations. Let's do a quick peek here. And just see if we can compare some of their annual filings. See if how their growth has been. Or you know what? I don't no SEC filings available. Good one. Oh, that's right, because they just went public. Ah, yeah, of course. Okay, so I could look at a quarterly. That's a good point. Darn it. That's one of the things that sucks about companies that just went public is you don't look at that. Check this out. First 6 months of 2020, 144 million. The first 6 months of 2021, 155. So they've grown, what is that? 7.5%. It's a surprisingly low growth company for something that just IPO'd. It makes you think like, oh, no, we're going to grow like crazy, right? But the growth has not been that great, honestly. Oh, yes. Look.
Getting into this space, how do you respond to all this competition?
Our competition isn't really any of that. You know, we've grown fast over the last 5 years. We've been growing at a compounded annual growth rate of 150%. But it's really not the other startups that we're competing with.
I believe once they launch car insurance, this could be a catalyst for Lemonade. I'm very interested in Lemonade because of that.
So as fast as we have grown over these last 5 years, we could grow 100-fold more, as I hope we will in the coming years, and we'd still be half the size of State Farm. So our eye is very much on that prize. That is our competition. That is the market that we're looking to disrupt.
And we mentioned, Daniel, it's your birthday, the company's birthday at the start, and congratulations on that point. But, you know, 5 years, given when you IPO'd more recently, 5 years actually felt older than I was expecting. So how many more years will you have of rapid growth versus things plateauing out, do you think?
I think we're in an industry that is as close to unlimited as one can be privileged to work in. So $5 trillion, 6 trillion, and as I say, we could multiply ourselves 100-fold and would only be a medium-sized insurance company. So
I'm gonna pull back here. Look, I love Lemonade and Daniel, by the way. He's been on the channel before. It's great. This right here is a very good point. I totally agree with Jesse here. ASTR, I'll look at that. ASTR, very good point, because something to keep in mind is, yeah, we at 9:30 tonight, which is 6:30 California time, the Hong Kong stock market does open. The I'm sorry, wait, no. Hong Kong's closed tomorrow. Shanghai opens tomorrow because Shanghai was closed Monday, Tuesday because of the holiday, and I'm pretty sure Hong Kong is closed tomorrow. But the Chinese government comes back tomorrow. And you could see pain reflected in the Shanghai stock market. But either way, I get what you're saying. I agree with you. There's that potential of a crypto dip, even leading into the opening there. So what's Astra Space? Yeah, was this a SPAC? I have trouble with the SPACs, and I know ChargePoint is a SPAC as well. Hold on, what's the breaking news?
Sarah, as expected, this has been reported earlier today, and it's been floating around, and now we have it. The Department of Justice, along with 6 states, are suing American Airlines and JetBlue, seeking to halt or dissolve their Northeast Alliance. What is the Northeast Alliance? It is a code share agreement between American and JetBlue, went into effect in February earlier this year with the blessing of the DOT at the time, that essentially allows them to coordinate their schedules and services to a certain extent with the 3 New York metropolitan airports. We're talking about LaGuardia, JFK.
It seems like nobody cares. I don't see American Airlines really moving on that. JetBlue, JBlue. Yeah, I don't really see them moving at all on that. In fact, let's just see what else is moving here in the after hours. Oh my gosh, look at that. Emrin 28% in the after hours, 10% on Rocket Lab. Oh, that's incredible. These momentum plays are so fun because look at Emrin. Okay, this is Emrin. And then all of a sudden you just get an after hours. But Emrin has like a teeny tiny market cap. It's so dangerous. And I have bagged on this company so long, not because I have anything regarding the company, just because I know somebody's manipulating the crap out of the stock. And so I encourage people not to be bag holders. I know it's very seductive to see those big numbers, but it's very different to see that than even see like a 4% move on Tesla. Is very, very different than like a 28% move on one of those small ones. Just worth mentioning. Okay, so I would consider actually putting Lemonade in the pain bucket. SoFi too. I'm going to do that. SoFi, Lemonade. I think that might be an easy way to do it. No, I see you here, Matthew. What you got, man? I can't get every answer here. If you want to guarantee, like almost a guarantee that I could get every single question, check out the courses, because when we do the private live streams, that's where I where we specifically go down the questions. How's Twilio been? That's another one. Twilio's been a sideways mover, huh? That's interesting. Yeah, Twilio. I'm going to put that on a question mark. I am going to move Google over. I'm going to put Google over because we're going to call it the Cash Park / Pain Pie. But that not to be confused with high risk like the SPAC pie, even though we do have ChargePoint in it. Yeah. And I'm going to decide on the Chargers. Faded Polo, what's up, man? I see you. Lucid covered calls was my question. Well, the problem is it's been on this insane run. Like, I'm a big fan of covered calls, but you might get sold out, which I don't think is necessarily a bad thing. I mean, you've got a pretty incredible volume spike over here in Lucid recently. Yeah. You know, there's a lot of talk right now about them getting ready to do deliveries. I'm skeptical, but I'm interested. So I'm willing to pay attention to this. But oftentimes you get buy the rumor, sell the news here. But Matterport and Lucid have both had these incredible runs here over the last few days. And, you know, I appreciate it. I applaud them. I think it's great. My sold puts are very happy. All right. So let's let's do some more suggestions here on stocks. See, United Wholesale is another one that I find so interesting, but it's one sec. It's another one that has sort of evaporated, and I really think, I mean, it's a SPAC as well. I really think the real estate plays are right now. Tritium. I'll write that one down. Tritium. XRX. I don't know. Xerox. I wonder what growth Xerox has. Huh. Okay. Let's see here. Okay, let me go to the Bloomberg really quick, and let's look at Xerox. Okay. Xerox Holdings. So financial analysis on TDoc. I'm going to look at that too. So Xerox. See, Xerox is facing negative growth though, which kind of, if you think about it, makes sense. Like intuitively, it makes sense that that Xerox would be, you know, having an oopsies. Emrin has an agreement with Google. Let's see. Let me see if that's true. Because it's been a big files packed with Google. 8K. Let me read that 8K. Hold on. Let's see here. Okay. So this is Okay, here we go. So Emrin entered into a revenue share agreement with Google to develop enterprise tech platform and software products. Okay, that's very vague. Agreement is effective as of October 1. Agreement will take effect after a scheduled termination of existing revenue share. They already have an agreement. They already have a freaking agreement. What's the difference? This is like they're renewing an agreement. This is so it's running probably because people are it's running because people are thinking, oh my gosh, Emrin has a partnership with Google. They had one. This is like saying, hey guys, I'm renewing my lease. To the moon. Let's see if there's something different. Okay, I've only read 2 lines into this, but that's more than what 99% of Emrin traders have done. The company will receive revenue payments from Google based on company share and connection search ads appearing on Google search only. Revenue generated on the company's tech platform in connection with the company's clients' spend on search ads. Okay, during a relevant quarter. So it's some kind of it's like placing. It's revenue share agreement essentially when they sell ads to their clients. Okay, got it. Revenue generated on company's tech platform search ads appeared in eligible search engines. Blah blah blah. I mean, to me, this doesn't look any different than what it was before, but I don't know. But each revenue share payment will be consistent of baseline revenue. This is very generic. The company will reinvest a fixed percentage of baseline revenue payments received during the term to drive tech platform innovation. Well, of course. Okay. The agreement terminates in 2024. I mean, to me, this sounds incredibly generic. This sounds incredibly boring. This is not a pact. Look at this. Look at this crap, okay? Hold on. Where is it? Right here. Street Insider. Emrin enters revenue share pact or agreement with Google. They already had one. This is such nonsense. At least they say it of the existing revenue share agreement that they signed. But that title implies it's something new, and it's such a joke. It just bothers me, this kind of stuff. Sorry, no, that's not news. 46% on not news, folks. This is what I'm telling you. This, in my opinion, is unsophisticated garbage. And all this is going to turn into right here is what you see right here. Decay and garbage. I'm sorry. I don't want to be like oh yeah, Apple is down. You're right. Write that down. That's not to be offensive to Emrin. Like, I'm sure the company's great. I'm sure the people are nice and stuff. But let's be real. The stock got pumped, and I think it's a little unscrupulous. But anyway. All right. So let's see here. Yeah, 46% on no news, and Tesla goes down in every earnings call. Bingo. That's crazy. All right. So Rocket Lab. Okay. Hive, Bedbeth. Seagate. Seagate had a big pump for a moment because of excitement around people buying hard drives for a certain cryptocurrency. And that's kind of evaporated. Although, I wonder what Seagate's growth is like. Hold on a sec. Yeah, I'm really just trying to find the darn opportunities in the market right now. And it's just been slow. Stonk market. All right, let's look at the financial analysis here on Seagate. So Seagate, it's low growth. 1% growth in 2020. Negative 7% growth in 19, 1% growth projected, 1.5% project, 1.9 for 2023, 1.6 for 2024. They are saying 11% in 2022, but still super low growth, super low. Gotta love day trading. Yeah, that's what that is. That's the day trader move there on Emrin. Just be careful, because the problem is like There are a lot of folks who are like, yeah, I'm a trader, and they buy it, and then it goes down, and they're like, no problem, I'll just hold it. And then they end up leaving comments like, I'm a bag holder on whatever. It's like, that's because you bought a momentum stock, holding it like it's Apple. It doesn't work that way. They're very, very different companies. Well, not so much the company themselves, but the fundamental valuation. Like, in my opinion, this Dutch Bros stuff, that's what we should look at. This Dutch Bros stuff is another insane one here. Okay, bros. Dutch Bros. All right, let's look at the financial analysis for Dutch Bros, okay? Because this one's nutty. Oh, I don't even get forecasts on this crap. And we've looked at this before. They had nice revenue growth in 2020, but I don't even have 2021 numbers. We have to go to their actual earnings sheet here. 8% to the bottom line, though, on EBITDA. For a coffee company? What's Starbucks? Let's look at Starbucks. Hold on. Before I look at that one, I'm going to pull up Starbucks. Starbucks. By the way, you could end up with some peak fear around China tomorrow. So whoever's talking about win. But we talked about 11 a.m. win. I'll write that down. Okay. Sorry. What? Oh, financial analysis. Let's look at. Okay. Okay. So EBITDA. See. Okay, folks. This is insane. All right. You want to know why Starbucks goes to the freaking moon? Because they have figured out to have gross profit between 28 to sometimes 30%. And their net margin, with the exception of 2020, which makes sense, they got pummeled in 2020 because of the pandemic. They have a net margin of that was 2020, of 12 to 13%, and projections going out to about 13%. They bring money to the bottom line. Their EBITDA margin is 22 to 28%. 28% looks like it's 2021. Looking like it's going to be 22 to 23% going forward. So net income margin around 13%. So let's use this as a comp to just kind of compare to Dutch Bros. And then for consumption goods, you can often also do a multiplier of revenue to market cap. So expecting 29.1 billion. And what's the Starbucks market cap here? Starbucks market cap. So we're expecting Starbucks market cap is 132 billion. Holy crap. Starbucks is huge. We're expecting revenue of, that's year. 2021, 29 billion of revenue. So Starbucks is selling for 132 divided by 29. They're selling for 4.5 times revenue. Okay, I'm gonna write that down, okay? S-Bucks, 4.5x rev. And we have the EBITDA margin around 22%. EBITDA, okay. And then the net around 13%. Now, let's go to Dutch Bros. Ooh, Intel's gotten smacked because of failure to innovate, honestly. Investor relations, which I think is a little excessive. Okay, let's look at Starbucks here. No, not Starbucks. Sorry, Dutch Bros. Dutch Bros. Investor relations. I think I've only been to a Dutch Bros in Vegas. Isn't it in Vegas? I don't think I've seen it out here. All right, let's look at their financial. So SEC filings, they should have an S1 because they just went public. Here we go. Well, that makes it easier. Here, let me do this. I'm gonna put this S1 on my laptop. Stand by. Or not on my laptop, my iPad. Okay, let's see what we got here. All right, we'll airdrop that over. Because Dutch Bros has been running like crazy. And I think the financials are going to help me know, is this thing undervalued? I highly doubt it. Because usually you don't, I mean, you might undervalue a little bit on IPO. This is true. But We'll see. I guess it depends on their strategy. We'll find out. We'll know within a minute before I speculate on that. Let me just pull it up. Let's see if this is fundamental or trader hype. My guess is trader hype. All right. Y'all ready for this? Okay, yeah. We're going to go right past all these beautiful pictures. And we're going to go to the charts. There we go. See, this is what I want to look at. Oh, sweet. They even gave me I don't care about the pro forma. I want 6 months ended in June. What do we got here? What's the growth? Okay, I remember. I've looked at this before. That's right. Their company-operated shops have exploded in revenue. That's okay. Yeah, and okay. So what's their revenue here? That's for 6 months ended. For year ended, they don't have a perform. Okay, so let's assume for the year they end up doing 306. Let's just double that. Okay, let's assume for the year they're going to do 360 million. What's their market cap? Dutch Bros market cap. Well, I guess I could double the bottom line number there. So make it 450. Call it 450. I don't understand why it doesn't show me the market cap. Well, here we have shares and calculations. We have about 43 million shares. 1, 2, 3 times 54.89. That's crazy. This thing is worth way too many zeros. It's only worth $2.3 billion. So I put that down. So $2.36 billion. And they're selling at, let's say for the year, they have about 440 rev. So 2.36 divided by 0.440, did we say? Yeah, 440-ish, 450. It's selling for about 5.3 times. That's not horrible. 5.3 times. 3x. That's not horrible, but let's look at their net. And then their EBITDA and their net income. Okay, so net income, which is right here in the last 6 months, they were able to bring 5.8 million to the net. I mean, that's pretty low. Okay, yeah. So where's all their money going? Cost of sales, cost of operations, income from operations, very low. Cost of sales. But it looks like their franchises are bleeding the money for some reason. See that? Their franchises are losing the money. So I wouldn't be surprised if they're trying to get rid of the franchises. Oh, sorry, that's SG&A. Hold on. Wait a second. Cost of sales. No, that's SG&A. That's not franchise. I'm sorry. That's their SG&A. Yeah, I misread that. My bad. Cost of sales 148 because their franchise model growth has slowed down substantially. Cost of sales in this case was, let's see, we had 148 in sales out of 180. They're spending about 82%. So that's about 18%. And cost of sales here was about 109. Yeah, okay. It's gotten a little bit worse. No, it's actually improved a little bit. Okay, yeah, their cost. Okay, so they were at about they were spending about 87% of every dollar they were getting just on cost of sales. Now they're only spending about 82%. Okay, so no, that's actually improving a little bit. But they're not bringing much to the bottom line, and that's really because it looks like their selling is there's still such a small company is what it is. So you're not going to get the same kind of margin as like a Starbucks. But let me do one more thing here, and then we'll look at what's going on with crypto. 69 growth here, 69,868 divided by 48,300. They grew their expenses by 44%, their SG&A. So this went up by 44%, and their revenue went up substantially more. If I just take out just look at the non-franchise, 180 divided by 109, 65%. No, I mean, they're growing. They're more expensive than Starbucks right now per revenue, and they don't yet have the net. But you know, if you were going to compare Dutch Bros to Starbucks, you'd probably go 2.36 times 4.5. Oh, sorry. Hold on. Divided by 4.5 times 520. Okay. Yeah, they'd have to have about 20% more revenue than they do right now. So maybe on a revenue basis, they're like 20% over. So even if you pulled off that 20%, that'd still be a $45 stock. It's not bad. $45 is just a little bit above. That was their second day after IPO, and they've kind of ran since then. So $45 probably puts them somewhat close to IPO. Yeah, this is what I figured. Looking at their earnings, that for some reason they're cutting out the franchises, and that's what they're doing here. Very interesting. Okay, so Emran's still running on no news. It's just after hours trader speculation here, which is really kind of entertaining. Like, I'm just like, can I short this thing? That'd be so funny. Like when people realize this is like no news. I think I just like, this is so stupid. Like I don't short stuff usually, but just for the giggles of it, $10. Let's see, how high did this thing run before? 27. I'm kind of down to short it. That's pretty evil, but it's running for such stupid reasons. Am I allowed to short it? Hold on, let me see here. Market. I don't know. Let me just try to short one. Time and for. Hold on. Let's see. Short Emran. Oh, come on. You can't short in after hours? Man, get out of here. Darn. Okay, I'm going to write that down. Short Emran tomorrow. Short Emran. Come on, man. Well, you can buy it in after hours, but you can't short it in after hours? That's a ripoff. That's a ripoff. All right. Let's take a peek here at crypto quickly because I hear people complaining about crypto. Ooh, I like it. Oh, this is good. We're gonna watch crypto here, and yeah, because I need to transfer funds to Coinbase. Yeah. Oh well. Okay. So what else do we have? Yeah, look at the crypto sell-off. I believe is very much related to what we've got going on. Try a limit order. Okay, a limit short. You think so? Let's try. That's a good point. Trade short limit. Okay, I don't know. Let's say I don't know. Hold on. Yeah, just leave it at I don't know 9.75. I don't know what it is right now. I'll just try it with one share. I just want to see if it'll work. Day in force, good to cancel, extended hours, yes. There are insufficient shares of this stock available to borrow. I can't even borrow one. Yeah, it's a bummer. Nonsense. Well, that's the kind of crazy hype that you get in the trader world, which, hey, you know what? If you can trade off no news and make money, yeah, no shorts after hours, hence the run. Yeah, no kidding. I mean, that really, in my opinion, takes the market's opportunity away to fact check this stuff. So there we go. Oh, this is cool. I gotta do like a identity verify thing in here because I'm trying to transfer some money between these crypto brokerages. That's why it's running. Yeah, no kidding. All right, cool. So yeah, good dip here on this. We do, by the way, in about 3 minutes have Smile Direct joining us, which would be kind of cool. I'll be excited to see Smile Direct. Smile Direct has been pretty well shorted. You've got you know, good old litigation. You've got it went down in August to $4.63, sitting at $6.47 right now. You've got I think a lot of FUD about Smile Direct. Let me pull up the short interest really quick on it. Let's see, Smile Direct, and pull up financial analysis as well. Smile Direct and the Black apps. Okay, let's see what we got. So Smile Direct, we had revenue of 656 million, I believe. Is that? Yeah, in millions. Okay, 656 million. That's a lot. That was 2020. 726 in 2021, which is only a 6.8% increase. And that's because the pandemic. See, in 2019, we were about 750 mil. So you had a decline during the pandemic. You're expecting growth going forward at Smile Direct. You're expecting 15%, 20%, 20%, 28%. Interesting. Yeah, some real growth expected. When's profitability? 28%, 13 cents. Still negative through 2023. Profitable in 2024, barely. 25 cents in 2025. So on a forward, why would 25 cents? Really paying about 25.8 times. Very interesting. Okay, let's look at the short interest on it quickly. If anybody wants to know some short interest, we could do that pretty quickly and until we get our guest to arrive. All right. Okay. Short interest on Tesla, 3.38%. SDC for Smile Direct is percentage of float, 34.66%, and it's gone up. Short interest on RWLK. I don't know what that is. That is 0.48%, so next to nothing. QuantumScape is at 18.76. Lucid, let's type that in. LCID, 7.41%. It's actually gone down in the last couple weeks. Emrin, 21.39% short. So somebody's able to borrow the shares apparently. JMIA, Amazon of South Africa, huh? 14.59%. PKK. It's not Peak Financial? No, I don't have PKK. It doesn't show up. Skills. Yeah, no, tomorrow's going to be very interesting with Chinese government coming back to work. Yeah, they had to take their time off. All right. All righty. All right, let's talk Smile Direct. Hey, Kyle, welcome aboard. Thank you so much for joining as the Chief Financial Officer from Smile Direct. How's it going?
It's going well. How you doing? Good to be here.
Very good. Thank you so much for being here. This is so cool. We've got so many questions for you, and I hope if you don't mind, we'd love to just get right into them.
Yeah, that sounds great. Love it.
Awesome. Thank you. Throw you right into the line of fire. So, what is your opinion? Why are so many folks shorting Smile Direct? It seems like you're at like 34% short right now. The stock has gotten pummeled, I would imagine, much by these short sellers, kind of align these things here. What's going on? What are people complaining about?
Tough questions from the start.
And quickly, since this is all about clean teeth, I'm going to drink through the straw here, my coffee. But yeah, go ahead.
Perfect. Yeah. Well, look, I think, anytime you do something disruptive, as with many other disruptive businesses out there, it takes time to understand the business model and the complexity. And I think if you look at our story, and it's been a short one at that, with incredible success over a very short time period, but it's a difficult business to understand. And so there's a lot of noise, certainly from an investor perspective, if you look at what's been out there since we've gone public. And I think the important part for us is really continuing to focus on the mission that we have as a business. We're a very mission-driven brand and a company, and I'm sure we'll talk a lot more about that. And we've got to stay focused on executing against that plan. And so, I think if we do that, the short volume that we have on the stock will take care of itself in time. But a lot of that is just associated with purely the the noise that we have around the business, very similar to many other disruptive brands that you see out there in the market today.
Got it. That makes a lot of sense. So there was talk about some folks, because I mean one of your competitors, I believe, is, and I imagine you do as well, is Invisalign. But the difference with Invisalign is that people have to go to a dentist, and correct me where I'm wrong here. They've got to go to a dentist and they get the professional molds done or whatever. Smile Direct, my understanding, is more of something that you could do from home. This is why your company name is Smile Direct, because you're bypassing that normal dentist chain, which is very expensive. I mean, I had Invisalign. I think it was like $5,000 or $6,000 or something crazy, right? And so, can you speak a little bit to those differences, and then maybe also some touch on why some folks have said maybe there's a downside to skipping that dentistry? Are certain people's gums not capable of maybe receiving aligners, and could those cause problems? And
yeah, let me be clear. There is 100% a dentist involved in every single one of our cases. The only difference is dentist or orthodontist, right? The only difference is with us, our members have the option to do it 100% remotely. They could also start their journey in person at a dentist office, but we have come up with a teledentistry platform so that you can interface with your dentist completely remotely. Very similar, quality of care, standards of care, clinical outcomes, clinical efficacy, but you can do it all through our teledentistry platform versus having to go in person every couple of weeks to see your ortho. And so I think the decision that people are making in the marketplace today is, do I want to have that in-person experience every couple of weeks, or do I want to use a teledentistry platform? If they use a teledentistry platform, we win today the vast majority of the time. And one of the initiatives that we're focused on, which the launch of selling through the dental practice, is actually starting to take share from those people who actually want to go in person. And I think if you look at, you go to our website, you can see directly on there the why Smile Direct Club versus Invisalign. And I think there's a lot of very compelling points there that will help people understand that they can get a safe and clinically effective outcome, but do it at a price of $1,950 instead of $5,000 to $8,000 or 3 times more expensive. And so all of that is made possible by the teledentistry platform that our doctors use.
The teledentistry, are you using Teledoc to set this up?
So we're not, but it's a similar platform. It's our proprietary technology that we created, and our doctors, use that portal. They can video interface directly with their patients or our club members through that platform. Got it.
Now, the dentists who answer the call, so to speak, are these employees or are they subcontractors? How does that work?
Yeah, so we're set up legally as what's called a dental service organization. And so we contract with professional corporations that are independently owned by dentists or orthodontists, and we provide a range of non-clinical services to those professional corporations. So they're not employees under the strict sort of legal standards that we have to abide by, but there's lots of dental service organizations that have operated for a long time in brick and mortar practices, and we're structured in a very similar fashion to that. It's just all done using our teledentistry platform. To the consumer, it's no different, right? They view when they come to our website and they choose if they want to go to a dental practice, or if they want to order an impression kit, or if they want to go to our Smile Shop. They view that dentist all part of our network and view the entire experience as part of Smile Direct Club.
Got it. Okay. Now, what about the pandemic? The pandemic seems like it hit revenue a good amount. Lost about $100 million compared to what the $750 that you had in the prior year. How have things come back? Has it been slow growth coming back? What is it taking to get people to come back to Smile Direct after COVID? And you'd think that, hey, it's you could do it online. You don't have to go to a dentist office. But it seems like maybe people care less about dental care right now during the pandemic. How has that been hitting y'all?
Yeah, so I'd say that if you look at the pandemic when it initially happened, for us as a business, I think what it really just highlighted is the agility and flexibility that we have from a business model perspective. Mm-hmm. So, people come to our website. We've got almost 5 million unique people per month that are coming to the website every single month, and they're choosing if they want to order an impression kit or go to one of our Smile Shops prior to COVID, about 90% of people were going into a smile shop. We had to shut all of those down in the early stages of COVID, and 100% of people were going through impression kits. And so just a complete pivot in the business model. And as we've come out of COVID, we've been able to rebuild our smile shops in a way where we're operating them at a much higher utilization. And so pre-COVID, let's say maybe the shops were 20% utilized. Today, they're closer to 60% utilized. So the shops are much more profitable. We've rebuilt it in a much more scalable way as we think about the longer term trajectory. And we've also built partnerships with dental practices. We're in about 500 practices today, and that's rapidly growing as well. So I think COVID has enabled us to change the business model from a perspective of where consumers are going and how they're interacting with us. From a revenue perspective, as you mentioned, down about 100 million. I think if you look at it from a quarterly perspective, we really saw the biggest impact of that this past quarter in Q2 of 2021. And if you look at our core demographic, and it goes back to the mission of the business and what we're so passionate about, our household income on average is about 65, 70,000 in household income.
So the average, well, household income is actually on the lower side, actually, because regular individual income is somewhere around, I feel like 59,000 in the United States or something like that. You're saying household income. Okay, gotcha. So lower demo.
Household. So it's a lower demo. And that's, what the mission is all about. It's about, democratizing access to care, making it affordable to everyone, making it convenient for everyone. But that demographic, in particular in Q2, from a macro perspective, is hurting, right? A lot of the stimulus packages have worn off. If you look at the impact of inflation in particular, it's hurting our demographics. So we don't believe there's any sort of long-term fundamental changes to the prospects of the business as a result of that. But certainly some near-term headwinds if you look at Q2 in particular as a result of some of those macro factors. And that's why moving upstream to someone who can afford to pay $5,000 to $8,000, but they realize, why would I pay that 3 times markup when I can get safe and clinically effective outcome that Smile Direct Club is going to guarantee for life. Why would I do that when I can pay $1,950? And so that's why diversifying our demographics is so important long term.
Now, what about? I'm just looking here. It seems like you've got long-term debt as of the last filing here, somewhere around 733 mil. Lease is only about 26 million of that. Where's all this debt from, and how does the debt affect your the potential for having to raise capital? Looks like last quarter you had about 376 million in cash, receivables about 214. Do you have any trouble getting people paying for your receivables or any issues with the liabilities you have?
No. So if you look at as you point out, between cash and the receivables that we have, well over 500 million of liquidity. And we think that certainly gives us, enough liquidity on the balance sheet to get us to cash flow profitability. And the debt that we raised, we did a convertible offering in March of this past year, and that offering, comes due in 5 years. It was a great deal where the current shareholders took on minimal dilution, right? So we put in a clause in there where our shareholders don't take on dilution until the stock was up 100%, so into the high 20s before the existing shareholders would take on dilution there. So
because that was done around $10 or so.
Yeah, we struck it. It was actually slightly higher than that, but we put a cap call where it was up 100% before there was any dilution. So it was a really low cost of capital. The all-in cost of that debt is about 2% a year. 0% cash coupon bond. So very efficient cost of capital for us to grow the business, and certainly finances the cash burn that we have over the next several years. If you look at the burn that we have, all of that is associated with just the sheer growth initiatives and opportunities that we have as a business. So, we're in what we believe to be the very early stages of a massive market opportunity. We think there's 500 million people globally that have some type of crowding or spacing issues within their teeth and can also afford to pay for treatment as well. Less than 1% of those are treated annually. So we're investing heavily in our brand to be able to capture market share there long term. We're also
it looks like you spent like 3 times as much money on marketing this last quarter than you did in 2020. Is that where most of the money's going to, or like how do your manufacturing costs scale? It actually looks like your cost of revenues went down despite your revenue going up. substantially from 2020 to 2021, at least on the 3 months ended in June.
Yeah, so we've automated a significant portion of manufacturing.
Okay.
If you look at our long-term target for our gross margins, we've got an 85% gross margin target out there. A lot of that has to do with the automation that we've built around manufacturing, and we're pretty close to achieving that target today. So gross margin, to your point, we've come a long way there in a very short period of time.
So how do you do that? I mean, because you're manufacturing a product. So yeah, it looks like right now you're somewhere around 79%. But how do you go from well, let me rephrase my question. My understanding is you sell products, but you also have the service. Is the product just very high margin then? I mean, I imagine it must be. I mean, because they're molded, like essentially plastic. It can't be that expensive to actually make the individual product. It's more the marketing and acquiring the customer and getting it to the customer, and maybe the service of providing the teledoc experience, right? Well, I shouldn't say telehealth experience.
That's right. And look, that's what we found so fascinating about this industry, right? The cost of the plastic in perspective of the cost of the total system is very, very small. So
I see.
An Invisalign would sell the aligners for maybe $1,250 to the dentist or the ortho. They mark that up 3 times and sell that back to the consumer. And so that's where we saw the opportunity for us to come in with a product that is, from a clinical standpoint, safe and efficacious, but costs 3 times less at $1,950. So there's the cost of the product itself, and then there's everything that wraps around that. So we're investing heavily in the brand today. One in 2 consumers, if you were walking down the street and asked them if they're familiar with Smile Direct Club, would say yes. So our aided awareness today is very, very high, and we're building a brand there to support long-term growth. But it's also the growth initiatives that we have as well. We're investing heavily into innovation, research and development to continue to disrupt ourselves on the product side. We're investing heavily in international expansion. We just announced France. That's our 14th international market in just over 2 years that we've expanded into. And so there's a lot of areas across the business that we continue to invest in, which is where you see the cash burn that we have quarter to quarter coming in. It's really to position us for the longer term growth that we see, just given the massive market out there.
That makes sense. How, so you mentioned earlier inflation. Where are you seeing inflation? I mean, the cost of the plastic going up can't be that much of a burden to y'all. Are like ads getting more expensive, or the people more expensive? The people that you're doing the telehealth with? What's going on?
Yeah, that's more of a direct impact on our core demographic. I see. Second quarter, if you look at revenues, being off of where we expected them to be, a core part of that was just the impact that we saw on our core customer. So, non-discretionary items. So the cost of gas, as an example, was up significantly. If you take a household that's making $65,000-$70,000 and inflation's up 6 or 7% year over year, that's several $1,000s that has a big impact on that household, which would equate to the cost of a liner. So it was a near-term impact. Inflation was one example that we saw on the cost of or the impact to our core demographic there. Again, I think all of that's transitory. I don't think there's anything out there. If you look at the long-term potential of where we go, we don't think there's anything there from a long-term perspective that impacts the growth.
I remember, and I might be slightly off on exactly the statistic, but I remember reading something from the Federal Reserve that 40% of those making less than $40,000, which would probably be within your demographic, 40% of people making less than $40,000 are in either retail or hospitality or some form of service industry affected by the pandemic. And a lot of these folks are still unemployed, even though companies are rehiring. Some of them have lost their skill set. They haven't gotten vaccinated. The more people in this demographic are unlikely to get vaccinated, right? So it almost seems like it's going to take longer, and it's going to be harder for this potential demographic to get back to profitability, so to speak, and potentially being a customer. What can you do to scale up? I mean, is there a reason maybe the demographic is lower? What's stopping people who use Invisalign from using your product?
Yeah, it's a great question, and it's all part of the strategy that we positioned ourselves for. So I think we've recently launched what we call the Challenger campaign, right? And so what that is it's starting to go directly head to head against Invisalign, and it's to help people understand, as I said before, why would I pay 3 times more when I can get a safe and effective outcome, using Smile Direct Club and their teledentistry platform? And the goal over time is for people to truly understand that messaging. And so that's exactly right. Over time, we've got to continue to move and expand our demographics to be able to take share from people who could afford to pay $5,000 to $8,000, but choose not to because our platform is more accessible for them. It's more convenient. They can do it all remotely, and it's much more affordable as well. So giving them the value for the product. So that's all part of the longer term strategy that we have that takes share within the broader orthodontic category.
I was thinking about that too. How maybe this is more of a technical thing, but how does a teledentist evaluate my gums? For example, do I mirror it? Like, how does that work?
Yeah, so they have. If you go through the process, if you order an impression kit, or if you go into one of our smile shops, or if you go to one of our dental practice partners, they're doing an initial assessment and review based on oral pictures. So you take a variety of pictures where they can see the structure of the gums, they can see your teeth and the position of them.
So it's not Zoom; they're actual pictures. That's good. Okay, that's good to know.
Yeah. They're actual pictures, and then if they need more information, so a dentist who effectively the process would be, and let's say you ordered an impression kit, right? So you'd order a kit to your home. You would do the mold directly in your home, and it creates a mold of your teeth, and you would take the pictures. You would send those into us. That effectively creates a digital image file, no different than if you went into a dentist practice. They're going to do a scan of your mouth, and that creates a digital image file. From that, we map out how your teeth are going to move throughout treatment. All that information is going to your state licensed dentist or orthodontist. There's a quality check. We have a clinical team, over 100 dentists inside that are employed by SDC, where we do a quality review prior to it going to your state licensed ortho or dentist for them to review. But they're looking at all that information. They're looking at your medical and dental history. They're looking at the oral pictures. They're looking at the scan itself or the impression and the treatment plan. And so based on all of that, they can push it back to our team and say, I want to make these changes to the treatment plan and move these teeth in a different way. They can approve the plan and say, yeah, this looks great. They could deny the plan and say, you're not a good fit for orthodontics for a variety of different reasons. Or they could push it back to the patient and say, you need to go for clearance. And so clearance would be, I need an x-ray, or I need you to go for a perio test. They see something in the gums they didn't like. And so with the pictures that we get and load into our teledentistry platform, there's so much the doctor can do with that. And so today we can treat about 90% of the cases that are coming to us from, just from the information that we're gathering. And then if needed, the clinical team, the dentist can get on the phone as well throughout treatment with the patient, actually go through the video chat and understand how the aligners are fitting, triage any problems, bring them back in if needed as well. So the clinical outcomes, clinical efficacy is no different than if you're going to go into a brick and mortar practice. And that's been a critical message for us to get out there for people to understand. You're going to get a safe and effective outcome. We actually guarantee that for life now. We'll guarantee the outcome of your smile as long as you're compliant with treatment, you wear your retainers. We'll guarantee the outcome that we're providing to people.
What's it been like trying to partner with actual dentists who have their practices? I shouldn't say actual dentists to say that your dentists aren't actual. I mean, like existing practices, right? Who may already have Invisalign units or whatever. What's that like? How do you bridge that gap?
Yeah, look, I mean, we're if they want to provide Invisalign at the same time, we're not against that by any means. I think if you look at orthodontic care historically, as I said before, less than 1% of the market is treated annually. There's such a massive opportunity out there, and the GP market. When I say GPs, meaning general practitioner dentists, in particular, only about a third of all dentists prescribe any sort of aligners today at all, and so it's pretty low volume in the big picture of the entire dental population. And the ones that do are very low volume. So, you're going to have some that are high volume providers. You're going to have some that almost do none. But on average, they're only doing 3 or 4 cases every single quarter.
Oh, wow. For Invisalign, that's it.
Exactly. So it's a very small percentage in terms of revenue for their practice. So what they love about our offering is that we're bringing incremental revenue into their practice. It's highly profitable for them because there's very little chair time involved in our model, which is so important in a dental practice. It's all about chair time. And then we also bring the added value of our leads as well. So we'll go into a partner practice and we'll host a pop-up event. And so what that means is, we'll bring 100 patients over the course of a weekend into their practice that are interested in Smile Direct Club. And they'll have the opportunity to convert those members into dental patients. And so we put out an example with one of our biggest partners, Smile Brands, last quarter. We've already scheduled 1,000 referrals, be it through hygienes or other types of appointments, since we've launched in a pretty short period of time. The lifetime value of that for them is $3 to $5 million. And so there's massive opportunity from partnerships and leads that we're pushing into these dental practices as well, which is another thing that they're excited about. So it's been very well received. I think there's an evolution there where we've got to continue to help dentists understand that clinically our product is no different than other products on the market today, and continuing to deliver that message to help them understand our value proposition and the impact we can have on their practice. That's interesting. Yeah, change that. Is it like the name or something, or what has created that impression? I mean, have you if this was like, I don't know, if the name was different, would that make a difference, or is it just a matter of you're building the company? And I'm not bagging on the name. I'm just wondering, like, why is that impression there? Is it because it's online and just the price is lower, maybe? Yeah, I think it's look, it's disruptive, right? Take any industry that's been disruptive. The status quo is going to push back on that, right? So yeah. It's viewed as competitive to the bottom line of orthodontists, and clearly they view that as competitive. And so the dental I see. Okay. So sorry to interrupt, but what you're saying is if you sell Invisalign in your office, they're selling you the kit for $1,500. You're selling it for $5,000-$6,000. The dentist is like, hey, sweet, this is $4,000 or $5,000 a profit here. What's the profit with the Smile Direct? Is it then potentially? I mean, you said it's $1,900. What would their profit potentially be? I mean, yeah, it's a fraction of that. So our price is the same. It's $1,950. Doesn't matter if you order an impression kit or go to a dental practice. And so that's all about what I said at the start. It's about the mission, democratizing access, making it affordable to everyone. And so a lot of that noise that's out there, to your point, is because of that sort of confrontation and what's seen as competition. I think the reality is, completely understand that as an orthodontist. As a dentist, we've been very good for the industry. We've risen awareness overall of the category. We've spent a lot of money on marketing, which has continued to drive more patients into dental practices. We've got great partnerships with dental practices. So that's a perception that we're changing over time. It's not going to happen overnight, but I think we're making good progress there. And we've got a really strong clinical advisory board as well that's helping us make sure we get that message out there properly and help dentists understand that we can be a great partner for the practice. That makes sense. What about these? And I know there's a limit to what can be said here, but so I'm going to phrase this, I think, appropriately. Do investors need to be worried about these lawsuits? Yeah, I think there's sort of another misperception, right, that's out there. Yeah. If you look at the lawsuits, we're generally the plaintiff, right? And so we're not the ones, and there are some where we're not, but we're generally the plaintiff in the suits. And so I think when you look at what's out there on the legal side, and there's not too much I can say given we're in litigation on a variety of them, but we think we're in a very good position across all of them. The important part is, we're not going to let someone harm our brand, which at the end of the day is going to go against the mission of what we're trying to do, which is, as I said, about democratizing access to care, making it affordable for everyone, convenient for everyone. And so if someone is trying to damage the brand, we've got to take exception to that. I think that's what a lot of these suits that you've seen have been about. If you look at it from a regulatory perspective, we're in a great spot. We've won in almost 30 states since the 2020 legislative sessions. The broad acceptance of telehealth and teledentistry is something that was already underway pre-COVID. It certainly accelerated post-COVID, and we think we're in a very good position there. We've had some good wins on the legal side as well. If you look at the history of the business and where we've won, that's had a big impact on the business. And we think we're in a very good position with the cases that are out there today as well.
Any buybacks planned?
Yeah, not so. It's always something we're thinking about, right? I mean, what's the best use of our capital? I think for us, as we look at the cash that we have on the balance sheet and just the sheer growth opportunity that we have, the best use of our cash, at least for right now, is to continue to invest in the growth initiatives that we have out there. So, partnerships with dental practices, international expansion, the teen market, continuing to get our brand awareness out there, help people understand that, the clinical safety like we've talked about. So we think that's the highest and best use of our cash right now, but it's always something that we're looking at. Does a buyback make sense? Is that a better use of cash? And obviously acquisitions as well. We're always looking at technologies that we can bolt onto the platform that will continue to disrupt what we've built here over time.
Got it. Makes sense. Gosh, what else haven't I asked? I mean, that's been pretty thorough. That's answered a lot of the questions that I have. What am I missing? I mean, I know you also, because I don't own any of your stock, but I do have 2 toothbrushes and 2 tooth washing things. So thank you for that.
What do you think?
That can't be a big part of revenue though. How does that fit in? Is that sort of part of the kit that you buy?
Yeah, it's really so if you look at all the ancillary products, it's about 10% of revenue today. That includes retainment. All of those products are really about 2 things. So one, the biggest client there is Walmart. So Walmart does close to 40% of all oral care sales around the country go through a Walmart today. We're in 4,000 plus doors around the country in Walmarts. And so from a brand awareness perspective, it's great, great lead gen capability for us. And so it's introducing someone to the brand. It doesn't take a big conversion downstream of people who go from, buying a toothbrush to buying aligners for that to have a very material impact in our P&L. So there's a brand building lead gen aspect on the front end of that. But then on the back end as well, as someone has finished treatment, the ability to have recurring revenue there and own the bathroom through toothbrushes and paste and other oral care products gives us a recurring revenue stream, increases the lifetime value of those club members. So it really does both of those: lead gen on the front end, recurring revenue on the back end, and sort of wraps around the core aligner business.
That makes sense. Okay, got it. What else? What else do you think I'm missing here? It seems to me like, in my understanding, is your biggest challenge is really convincing dentists that they can do more business more efficiently working with y'all, and therefore make more money by selling the aligners and creating that sort of relationship. It does sound like a hard sell. So I wonder what percentage maybe of your revenues come from dentists with individual practices versus people going through your website.
Yeah, the dental side is very, very small today. So that's a new growth initiative that we've only launched. If you go back to last fall, we were still in a pilot. We only launched, call it this time last year, a little bit later, out of pilot mode with our first practice. So it's a newer growth initiative. We've grown that to about 500 practices over the past year. We've got close to 2,000 total in our network. And so, it is growing rapidly, but it's a smaller portion of the business today. We think important for longer term growth, but something that we're in the early stages of building.
Got it. So mostly online then. So then what's your most effective sort of advertising? Is it just, search engine, ads, or what do you like doing?
Yeah, I would say all the above. So, our strategy broadly is about driving people to the website. So if you think about how they get there, about 20% of the business today comes through referral. And so a pretty meaningful portion is referral driven. A large portion is organically. We've got over 50% aided awareness. So if you were walking down the street, 1 in 2 people are familiar with the Smile Direct Club brand. And so organically are coming to us when they're thinking about straightening their teeth. And then the third part of that is marketing. But we're driving all of those to the website, empowering them to order an impression kit, book at a dental practice, or go to a Smile shop. And on the marketing side, it's pretty broad. We're about 60% of our spend is online. We've got about 40% of our spend is a combination of offline, so TV, out of home, things like that. And online, it's all the platforms that you would think. So Google's a big part of that. Facebook and Instagram are big parts of that. But it truly is a multi-touch approach where we'll touch a consumer across multiple platforms if you think about the journey that someone has been on, having crooked teeth has been a lifelong problem for most people.
Yeah.
And so 90% of people have crooked teeth, could never afford to straighten, and something has happened to say, now's the right time. Could be a new job or a wedding or a divorce or a birthday, whatever it is, but there's an event that drives them to say, now's the time for me to do it. And so for us, it's really about generating the lead and then cultivating that lead over a long period of time to get them to ultimately convert to buying aligners. So it's a pretty complex, marketing strategy. We do almost everything internally. We've got about 100 team members on our marketing team, and do pretty much all of our creative and marketing in-house today.
What's the time frame if somebody wanted to, start the process? I'm sure this is on your website, but I'm just going to ask you.
Yeah, so on average, the treatment length is 4 to 6 months on average. And so there's not a definitive line within there, but that's an average treatment of about 4 to 6 months that someone would go through.
Okay. And I think probably the last question I have is what do y'all project in terms of path to profitability? I think Bloomberg has y'all as an estimate here of these are analyst expectations, somewhere around 2024, maybe profitable, yeah. Right? 25, somewhere in there.
So for us, I think the important metric for us is really adjusted EBITDA. So we're a growth business. We've spent so much in CapEx and other growth initiatives that you'll see that depreciation and amortization, hitting the P&L more so than other businesses. So the right way to think about it for us is adjusted EBITDA. The only real adjustment to that is stock comp. So there's not a whole lot of things that flow through there, as you might see in other private equity type businesses, as an example. But from an EBITDA perspective, we've actually been profitable for a while. We weren't this past quarter with the down quarter that we had, but we've turned profitable in Q3 of last year, and obviously very focused on getting back to that EBITDA profitability. But that's the main metric that we're focused on. If you look at the long-term metrics that we're going after there, top line is 20 to 30% annualized growth is what we're focused on achieving. And adjusted EBITDA margins off of that would be about 25 to 30%.
Nice. Yeah. Okay. Yeah. That it seems pretty consistent, at least with Bloomberg. Their conglomeration of all the analysts, they seem to put you between that 20 to 30% over the next few years of growth. So that's exciting. And that makes sense on focusing on the EBITDA, which then they're suggesting getting back to EBITDA profitability by 23. You think you can make it happen in 2022?
Look, we're not giving forward guidance, right now. But what I will say is the long-term targets that we put out there is what we're focused on executing sort of year in, year out. If you look at the next 5 years, the goal is to ramp to that 25, 30% by the end of that time period.
That makes sense. That's awesome, man. Okay. What else? Did I miss anything? I mean, this was really insightful. I really appreciate you coming on. I think it's worth just a quick disclosure. I'm not paid by y'all, and I don't own any shares yet. Who knows? Maybe we'll buy some shares. But I like to put that out there. Otherwise, you get the troll comments. People are like, "Oh, how much did you get paid for the interview?" Right. I got 2 toothbrushes and 2 tooth cleaning things. That's it. Okay.
Well, give us some feedback on the brush. We'd love to have it.
All right.
I think in terms of things we missed, I don't think so. I think we covered it. I think that just to kind of recap for us, I mean, our belief is we're in the very kind of early stages of what we think is just a massive market opportunity out there. Yeah. As a company, very mission driven. It's all about democratizing access to care. Like I said, we're disrupting a category that for a very long period of time has provided a 3x markup associated with care. We're removing that, consumers, making it affordable to everyone, making it convenient for everyone, and on top of that, guaranteeing that outcome for life. So, just remain incredibly excited and optimistic about where we think this brand can go over time, and doing it by at the same time solving a very important problem for people, which is fun.
Yeah, no, I love that. I think that's great. Yeah, I think probably one thing, if folks are really excited about investing in new opportunities, one of the best things I always suggest is just try the product. Yeah. So that I might have to sign myself up for a 4 to 6 monther, and I think when you're a user of the product, it all makes so much more sense.
Yeah, absolutely. We'd love that. We love feedback too. So, if you do go through treatment, definitely send in feedback. And for our investors as well, we do have a stock perks program where they can get discounts and other things like that too, which is a nice perk.
Oh, that's interesting. Okay, awesome, awesome. Well, hey, thank you so much. This was a pleasure. Anything else you want to add? Any shout out you want to throw in there? But otherwise, I'm done. Thank you so much. I'm going to go make myself another cup of coffee.
Thanks for having me.
All right, perfect. Well, thank you so much. Smile Direct CFO here. Thank you again. And folks, I'm going to end the live stream. I will post this video separately, so it's a standalone Smile Direct as well later today. So thank you, everyone, for being here. Thank you again. And shout out to Smile Direct. Thanks again, everyone.